Welcome to Market Monday from the investment team and the trust department at the First National Bank. Going into the next couple of weeks, there are not a whole lot of consequential data points coming, but there are a few. We'll start with those, talk about markets and what's driving them, and on fixed income like we typically do. We get information tomorrow on retail sales, and this is important, especially in the context of a potentially weakening or at least mixed message type economy that we're seeing at the moment with the different economic reports coming out. So it is important to know what's happening with retail sales. We'll get information on the housing market, production, the Federal Reserve Beige Book, where they go into what are the economic conditions in different regions of the country. We'll get information on the leading index, which is expected to show a 0.3% decline. And the leading index tends to forecast what's going to happen with GDP. This reading would indicate, should it be released this way at that level, that the economy is expected to show some contraction at some point in the future. So we'll watch that a little bit. That's moderately important. Purchasing Managers Index, that's sentiment, moderately important. Here's the main event. GDP annualized, the quarter-on-quarter growth rate, which for Q2 is expected to show 1.7% economic growth versus the 1.4% in Q1. So that says, hey, the economy may be strengthening, and that's at least what analysts are thinking, what their models are predicting. So that's one to watch. That determines, hey, is the economy going to remain robust, or are we going to fall into recession? How's it looking? We'll get information on the demand situation, and really what we're looking for is this core PCE number, the core being, taking out certain items from the basket of various consumer goods, and it's the Fed's preferred metric for inflation when they're setting policy. So we want to know what's happening here, and that's expected to show a slight decline from 2.6 in the prior reading to 2.5. We'll round out the couple weeks of here period with sentiment index, but let's move into the stock prices, because first, the S&P 500 has continued its relentless march higher, even hitting a new high for the year on Friday's session, before pulling back to close slightly below that. But in any case, this is a capitalization-weighted index, and what that means is it's being driven primarily by the growth in its biggest constituents, which in this case are mainly the Magnificent Seven and mainly technology companies. So technology now represents about a 30-ish% proportion of this index. So it may not be the best, arguably it may not be the best overall representation of the U.S. Corporate world. Let's go in and look at what the equal weighted index says, which takes, that effect out, that momentum effect. And what we're seeing is, wow, the broader market actually is showing some signs of finally waking up and moving higher, hitting a new high for the year also on Friday's session. So what does that mean? Potentially the broader market is showing some renewed vigor, and that could be propelling stock prices in general higher. That's a very positive signal, actually, from that perspective. And what's driving it? Well, the consumer price index, the inflation situation, that came in at 3.0% last time, while the purchaser's price index came in at 1.4. So what is that telling us? We've been over this on several other occasions in these videos, but for the edification of those who haven't seen it, if we proxy the prices of consumer goods as sales prices at 3%, and we proxy producer prices as input costs, we see that there's really a case where input costs are going up inflation-wise by a lot less than what they are able to sell for in the finished product. So what that argues is that corporate margins are increasing, and since corporate margins are a big part of the future valuation forecasts, that argues that stocks may in fact be underpriced relative to their long-term value, with future expectations of profits and earnings. So we'll watch that as well. And here's the core PCE index, which is now down at 2.6% as of the last read. And again, it's expected to come out at 2.5 for the next reading. And the Fed is actually apparently getting fairly close to being able to cut rates, although in our opinion, we're not quite there yet. This is the Taylor rule, which is an econometric model that's designed to tell us, hey, based on a targeted inflation rate, what is the policy rate that the Fed ought to be using? And this takes, the employment situation into account and what the core PCE is relative to its target. and says, hey, what should the overnight rate be? And the Taylor rule says 5.76, and the current rate is 5.5. So we're close, according to this widely respected, at least in the past, econometric model. Now, there is some debate as to its relevance that has crept up into the academic world and into the analyst community as to whether this rule is valid anymore. But those arguments tend to encompass the 40 or so year period where interest rates were doing nothing but going down, and there was globalization, cooperation, and you didn't expect a higher persistent level of inflation, which the bond market is clearly telling us market participants do expect. So we think this rule is relevant, and we think that this negative 26 basis point spread argues that we're not quite there where the Fed can cut rates yet, but we are trending in that direction, and at some point within the end of the year, or at least before the end of the year, we may in fact see this model indicate, yes, there is a case for the rate cuts. So we are going to soften our language a little bit and say, hey, maybe they will cut actually by the end of the year, whereas before this model was so out of sync, with telling us that rates needed to be much higher, that we just could not make that call. So now it appears a lot more plausible. And moving into the Treasury curve, when I say, in the last slide or the last pane that we looked at, that the rate is close but not quite there to get to 2% inflation, the model actually will tell us, let's jump back to it and say, well, let's make it 3.0. If we're targeting 3% inflation, there's 0.25% in there that the Fed can cut. So the Fed is actually, if they're using this model, targeting 3% and not 2%. And they have openly said they're willing to let inflation run hotter. But when we look at the Treasury yield curve, that is also baking in an inflation risk premium of approximately 3%. So that tells us the Fed's target is more like 3%. And if they cut, that would just be confirmatory of that stance. So, we're watching that pretty closely. Now, moving into the corporate yield curve, the rates are very good for long-term bond investors and for short-term bond investors. In the belly of the curve, it's not as great, but it's still pretty good relative to historical standards. And balanced account investors who are hedging away equity risk by holding bonds in their portfolio are getting paid a good yield to do that. And fixed income investors who are living on the proceeds of their portfolio or using it to match cash flows are getting paid very good rates. So overall, this is a good environment for fixed income investors. And let's close with the S&P, as we typically do. When the market's doing nothing but go up, there are a lot of suggestions that everyone needs to jump on board, and there's a lot of FOMO, fear of missing out, going on. What are we going to do with this? Nothing. We're going to stick to our long-term, well-thought-out investment plan that's designed to achieve client goals, not chase market returns. We're interested in these 10, 20, 30-year periods as opposed to what's happening over 1 year or a couple months. So we don't want to get shaken out when there's a bear market. We don't want to get too excited when it's just doing nothing but go up. We just want to stick to the plan and achieve the client outcomes. So if you found this video useful, we're glad that's the case. Feel free to reach out to us. We love to talk with clients and prospective clients, and have a great day.